Hello and welcome to the Sunny Point Investing Podcast. It's been a while and we have lived together through 2020. If you're listening to this, we have lived together through 2020. For all that the year has brought us or did bring us, I actually had a great year in the market, and so did a lot of us. It almost feels guilty to say that how good a year we had, but most of us had in terms of investing in the stocks, because markets bottomed and turned back and never looked back again and made new highs. And for me, it was personally one of the best years in terms of portfolio returns. Again, it almost feels guilty to say this, but if you stuck through this, congratulations. Today's episode will focus on the 2021 model portfolio. So we will discuss and walk through my picks for 2021 and what I published as a blog about 2 weeks back on December 31, I think, was on 3rd of January, was about a 2021 ETF, right? The Sunny Point 2021 ETF. It's a hypothetical ETF which has and holds 10 companies, which you can divide 1/10 amongst them and keep holding. And as the year goes, we will hopefully see how this performs, and hopefully it will beat the markets. So just one note on 2020 before we move on to this one is just the faith that we should not be scared out of the markets. And I'm not saying I bet the farm in March of 2020, but I did substantially erode my cash and went back into buying slightly higher quality assets than I otherwise would have. So that all helped a lot. And whatever the times bring us, of course, keep the capital aside that you need for any and all reasons. And of course, if there is a pandemic, you need a little bit more with taking care of your health, building some reserve, and also factoring in the instability all around. But if you've stuck through it, keep doing so. And today, let's now discuss the 2021 portfolio. Okay, there is no music, there is no producer. I just produced this myself. So here we go. Let's discuss the 10 holdings. The blog, if you want to read it in detail, is sunnygoklani.com is the website on which you can see a tab for blog and then Brave Bull updates, and then you can find the blog which says the 2021 ETF 10 stocks for 2021. It can also be accessed. The direct link to the blog is bit.ly/SPETF 2021. bit.ly/SP 2021 ETF, sorry. So that's the link if you want to check it out. Now let's discuss and walk through how I picked the 10 companies. The list reads: 1. Bristol Myers, 2nd. Merck, 3rd. Regeneron, 4th. Alibaba, 5th. Amazon, 6th. Lowe's, 7th. Salesforce, 8th. The ETF named Cure, CURE ticker symbol, 9th. Social Capital, HH, 6th, which is IPOF, and 10th is Altimeter Growth Capital, AGCUU. Now, let's look at the strategy. So if you think about how I came up with this, of course, let's get the caveat out of the way, right? Calendar investing is just luck based on where things are and where things move. And secondly, I have no idea what your risk tolerance is. So I've tried to not go very risky, and I've tried to also not go super safe, because if anybody wants to follow along, hopefully they'll get a mix, and hopefully we will get some risk adjusted returns and enough to beat the benchmark. If not, it will at least will be decently doing at the end of the year. So to get that mix right, I thought of getting 2 value names, 2 medium growth names at decent valuation, 3 high growth names which have had a pullback or a consolidation which has brought them to decent valuations, and 3 speculative bets. So this is how I constructed the portfolio. Start with the value plays. So the value plays, where is value right now? Of course, except the energy and financials, I looked at one area that is really appearing to have names that has a lot of value, which is biotech and pharma. So the two names are Bristol Myers and Merck. I did not include AbbVie, but if you include AbbVie, Bristol Myers, Merck, and AbbVie are the three large cap value names that I own in my personal portfolio as well. And just a note that I myself own all of the 10, so I would definitely not pitch something as a game or for just you to, tag along and try for me. I definitely own all of these, which means I definitely have skin in the game, and I want these to succeed, not just for this year, but more than that. But for now, I've picked these. So the value names Bristol Myers and Squibb. Bristol Myers, Squibb, and Merck. So both of them are nicely situated. Bristol Myers, let's talk about that. I was a long-time holder into Celgene. That got folded into Bristol Myers. Recently, Bristol Myers did not pay Celgene the rights, the $9 billion rights, CVR rights, for the 3 drugs that got approval, that had to get approval on a certain amount of period and time. So the Lizocell approval in December did not go through. So what did Bristol Myers do? It saved $9 billion and will probably pay debt back. It increased its buyback by $2 billion. And all the data in recent conferences have been positive. All the earnings have been positive. With all those taking into account, it still trades at less than 7 times 2021 EPS, adjusted for debt and dividend yield. So dividend yield is 3%. So it's a good dividend stock, good income stock, nice growth, all favorable fundamental moves recently, but still trading at very attractive multiples. So at the start of the year, the price that we picked up that was 62. So the starting price is 62. Second was Merck. So Merck is slightly more expensive at nominal terms at 8.5 times 2021 EPS. Again, adjusting for debt and dividend yield. Has much less debt than Bristol Myers, about 10% of its market cap. It also has about a 3% dividend yield. So both of these value names are also income names. They come with 3% dividend yields each. But it does have better visibility, right? So it has Keytruda, which has better visibility. It's a growth drug, and it has its expiry as late as 2028. That can be even further extended. Versus Revlimid, which was the main drug that Bristol Myers acquired to Celgene, will have its peak in 2024. So it makes sense for Merck to have a little bit higher multiple. So both of them are value names, are income names, are at a good valuation. And I believe both of them will do good by the end of the year. If not, definitely doubling down for the next year, I would say, unless the fundamentals worsen. So Merck, the starting point was 81.80 at the start of the year. Then I wanted to introduce 2 names with reasonable medium growth but good valuations. So reasonable growth, reasonable valuations, and those names were Regeneron and Lowe's. So Regeneron, have been owning that stock for a long time. Len Schleifer and George Yancopoulos, I hopefully said his name right. The duo has been doing a great job. Of course, in 2020, what they were famous for was getting the cure for COVID, the Regeneron drug, which also cured the president. And yeah, they did good, but then also a vaccine came in, thankfully. But for Regeneron, the people who started to get to know Regeneron because of that drug thought that that's a negative news because now the vaccines are out. So Regeneron took a hit, and in terms of sentiment, and it went down from 600 to about 480. It is still about to grow 10 to 15% per year. Eylea is running strong. Dupixent is growing super fast. And also, while that is going on, I think Regeneron will add about $3 billion in revenue this year, and maybe 3 to 4 in total because of this COVID drug. So business is booming. The pipeline is strong. Libtayo, the cancer drug, I think it's another pipeline within a drug, and it's trading barely at 13 to 14 times forward earnings. I mean, we know it's because of the threat / concerns around Eylea, and competition and Dupixent's competition, but I believe I'm sticking with this name. I believe it's a really good valuation. So we started the year with Regeneron at $483, which was 13 times forward earnings. Next one is Lowe's. So if you look through all the picks, once again, I ended up with a lot of healthcare and tech. Wanted to diversify a little bit, and that brings us to Lowe's, which is in the consumer sector, in the housing sector. The housing trend has been super strong throughout 2020. House starts, house sales, everything did great. House prices. Now, if you have such a boom in housing, which is even continuing in 2021, I believe people will continue to work on them, enhance them, buy different things, fix up different things, So if they're not buying, they'll fix up things. If they're selling, they will, prop them up. Or if they're moving in, they'll do upgrades. So Lowe's and Home Depot both stay really good. Lowe's has been trailing in valuation terms from Home Depot, but a lot of smart people have been in Lowe's for a couple of years now, including Bill Ackman, because of the turnaround it's going through. And the way the turnaround is working, I believe the valuation, how much it's been trailing from Home Depot, maybe does not really deserve that much. So at the start of the year, it was trading about 17 times forward earnings, 17 to 18 times. I think that's a reasonable valuation, a fair valuation for a reasonably high growing company. Definitely got a boost in 2020. The growth rate will go down in 2021. It may be even flat or negative, but the trend will continue, the secular long-term trend, and Lowe's turnaround. So the year that we started, Lowe's, we got it at $160. I'm telling you the prices because I also have an Excel sheet which is linked in the blog. There is an Excel sheet for the 2021 ETF portfolio where a sample $10,000 portfolio, $1,000 in each. It auto updates the live prices. It has the starting prices, and basically tells you how much that portfolio would have been worth if you started on January 1 and invested $10,000. And what's been the return so far, since the start of the year in S&P, and how are we doing in terms of performance delta. So that sheet is online and it's live, and I updated it on my blog and Instagram and Facebook. I've posted this anywhere. Hopefully you got it early, but now even if you didn't, it's just a couple of weeks now, you can still join along. So that's why I'm saying the prices, because you will see those same prices recorded there in the sheet. Those were the starting prices. So those were our two reasonable growth names at good valuations. So Lowe's and Regeneron. Now I wanted to add 3 growth names. So, typically known growth names which have predictable growth for 20 to 25 to 30 to 35% to 40%. So like predictable secular growth in 20 to 30 to 40% range. So those 3 names I picked were Amazon, Alibaba, and Salesforce. So Amazon has been, again, one of the beneficiaries of COVID-19 because it saw its e-retail business, e-commerce business, skyrocket. It also saw its AWS business accelerate because everybody was moving online. And after all that, again, now people are fearful of 2021 comps being difficult. So the stock has been consolidating as much as the markets have been moving last 6 months. Amazon has been just consolidating. It was from a high of 35.50. I think it's now pulled back to 31.50, 3200. That's the range it's been moving in. And that just feels like a long consolidation, which is something we have no problem with, Long consolidations give us enough time and patience for people to come in and buy. So this is one of the good times I believe we should add. With the year that we started, Amazon was $32.57, which I believe is a good starting price. Hopefully we will break through the range and go above it, and the AWS business will keep doing good, as well as e-commerce. So that's that. Alibaba. Now, Alibaba, I've been saying since some time, has been attractive, but it keeps falling after different news. One after the other, the news keeps hitting. Where is Ma? Ma is missing. And then the delisting related threats and rumors and speculations, and of course the IPO. All of the news, it's just like you just wake up and see a dead bullet coming at Alibaba every day and the stock falling. But I think it's pretty cheap now. So unless the antitrust threat is real and the government needs to really interfere with the businesses in a way that the business operations get hampered, I don't see any long-term effect as of right now to Alibaba's business or position or profitability. So it continues to grow. Revenue is at 30 to 50% for both the next coming couple years. At least the estimate and forecasts are to do so. And it still manages to trade at less than 19 times 2022 EPS. So its financial year is a bit early, so we can look at 2022 EPS. Less than 19 times. It's a steal. It's a steal. People who know why I laughed at that sentence will get something political out of it, and that's why I actually laughed. But anyway, coming back to this, I think it's a better than reasonable valuation. A good entry point. When we started the year, Alibaba was at 232. Next one, the third growth name we added was Salesforce. Now, Salesforce has been one of the stars in the market. Constant beat and raise every single quarter. It keeps outperforming. It's the fastest company to reach $20 billion in sales and will continue to do so. And it's on track to be, again, the fastest one to reach $25 billion in 2022 and $30 billion in 2023. It keeps growing at 20 to 25% rate clip, and COVID has only accelerated the business. It was keeping on its movement in stock price as well till it acquired Slack, and then the stock fell by about 15%. Since then, it has been languishing around 220, which is 8 times 2022 revenue. And I believe that this is a good, decent entry point right now with 8 times forward revenues, as in it's about 200 billion market cap now, so it's 8 times of 25 billion estimated in 2022. And hopefully the earnings keep outperforming and you will see the stock going back up. So at the start of 2021, the stock was at 222. Okay, lastly, let's discuss the 3 risk names, the speculative names. So I wanted to balance it out, all the value plays and growth names, but with setbacks. So not technically strong, not very momentum wise strong. These names can and are known to have underperforming periods versus S&P. So I wanted to add some spice. So most of you know I usually trade around in leveraged ETFs. I don't suggest people to do this right off the bat. I don't suggest people to put a lot of capital in it, but I do suggest if you know what you're doing, to play around and get like outsized returns. So given that I do that on the side, I wanted to introduce one triple leveraged ETF, and that will be Cure. Because as I said, I believe the sector that is not caught up with its with the stock prices haven't really caught up to its evolving and improving fundamentals has been healthcare. So Cure is basically CURE is the ticker. That is 3 times leverage of the XLV. And usually it's a lot of risk. It still is a lot of risk, 1/10 of your capital being in this, because I didn't want to weight it or make it super complicated. I just wanted to be 1/10. But I had to pick one. And given where we are, where the tech and semiconductors and biotech, all my favorite sectors, are doing pretty well, I did not go with Soxol, Tecal, or Fungu, like all those leveraged ETFs in those sectors. Instead, I went with Cure. Now, the biggest names in XLV, the index which it is leveraging, the biggest names are J&J, United Health, Pfizer, Merck, AbbVie. All of these I would individually buy. Maybe not Pfizer, but the valuation is still attractive. So as I said before, I already own Merck, I already own AbbVie, I already own United Health. I would be pretty good with J&J Pfizer, maybe not just because of the growth profile, but valuations, sure. So all of these are at very decent values. Rolling the dice, I thought if I had to pick a leveraged ETF, let it be CURE. So at the start of the year, CURE was trading at, what was it trading at? It was trading at 77. 77 is the starting price. Now what was the defining? Two left, right? So the two stocks that are left in speculative ones, well, if you had to think what all defined 2020 in terms of the markets, I would say it was the comeback of SPACs. SPACs literally defined a whole new era of risk-taking markets, companies coming to the markets, and returns. And I've had good returns as well. Clearly did not put a lot of capital into SPACs, but percentage-wise have had good returns. So I wanted to pick two SPACs. Now SPACs are a lot about banking on the guy or guys, as in people, who are running that fund, who will decide which companies to merge with. The better people will pick better companies, will have better connections, will get better deals, and will market it well. So it's all about the person, investor, or a group of investors when you're selecting a SPAC. And two smart people, two smart investors I have been respecting and investing alongside with are Chamath Palihapitiya and Brad Gerstner. So I wanted to be really grateful, I am, that both of these people have a SPAC. Chamath actually has a lot of SPACs: IPOA, IPOB, IPOC, IPOD, IPOE, IPOF. These are so far the SPACs he's done. IPOA was Virgin Galactic, IPOB was Open Door, IPOC was Clover. I have been in B and C. Now he had D, E, and F that are open to the market, and I selected F just because it is the larger in size, so maybe it gets an attractive target. After we picked F, we found out that IPOE now merged with SoFi, which is great. I love the positioning of SoFi and the long-term simplification of finances and other credit services. So I have actually bought IPOE as well now, but that is different, not in the ETF. The ETF included is we have picked IPOF. So now we're making a bet, right? It's a bet. Why is it a bet? Because we don't really know which company is it's merging with. Being a fundamental investor, I like to understand the company, what it's doing, what's the business, what trend is it building on, what problem is it solving, what are the margins, what's the business profile, what's the competitive mode, what are the projections, how bankable is the secular trend, and stuff like that. But here, none of that is known yet because we don't know which company IPOF will merge with. But that's a bet on Chamath. Similarly, the last one, AGC, Ultimate Growth Capital, we have its units, which is AGCUU, is from Brad Gerstner. Now, Brad is an amazing tech investor. His biggest picks have been Facebook, Uber. All these names now are pretty well known, but he was in them from the very, very start. And many other names in Pinduoduo, all of the names that are now pretty well known, he had been through very, very beginnings. And I have been following his fund and his movements, but now is a shot at making the most out of his deal making. So let's see what he gets out of this deal. But the bet is that he will probably get a good deal. So AGC, now, completely honest, being here, right? These are speculative bets. We don't know where and what they will buy, but it will probably be in the tech space. Both of these are tech investors. Chamath has been moving a little bit into fintech and climate change, so addressing companies. It might be that, but it might still have tech as an underground foundation into solving those problems, like Clover does for healthcare premiums and Medicare. So the starting points of IPOF when we started was $12.30, and Ultimate Growth Capital we started at $12.86, so $12.86. So today, 2 weeks in, the portfolio is up $522. So if you would have invested $10,000 to start with, today it would be $10,522. The total return would be 5.22%. The S&P 500 return in these 2 weeks has been 1.6%. So the performance delta is outperforming the benchmark by 3.6%. All of this I know has no value 2 weeks in. Things move pretty fast. It could go pretty negative anytime. You never know. Things are volatile. But we'll see how it goes. If you haven't followed yet, get in. Get in now. Get in later whenever the market falls. Or get in whenever one of the picks in this list falls. Or time distribute. But if you have a way to create a basket, if you have a way, like for example, if you're on Robinhood, as little as $100, you can put $10 each in all these 10 stocks, and you have mimicking the portfolio of this ETF. It's a good idea. It's a good idea to keep track of the companies. Listening to this podcast, hopefully you'll have a little idea of the rationale. So the reason I'm doing this is so that if you do start this portfolio, you know a little bit about why we're doing this, why we're picking this, so you can follow along those stories. And if you're starting investing, it's great to not only know where you're putting money in, but what's the thesis in, like the summary of the thesis, so that you can follow along. Because tomorrow, for example, if you don't agree with me saying housing will continue to be great, you swap out Lowe's with something else. And if you want to swap out anything, just reach out to me on any social platform and I can offer substitutes. For example, I got requests such as, for someone, SPACs might be too risky, they don't want both, so they may want to substitute it with something else. So there are reasons for that, but the only thing is then you'll not be mimicking the Sunnypoint 2021 ETF. But we don't know if this will really beat the markets yet. And so far, I have had couple observations. So for example, I wrote in the blog as well, one stock that I really wanted to add, but I was not sure if it would increase the risk profile by a lot of the portfolio, was Wayfair. I really wanted to add Wayfair at 220s in 1st of January. I believe it was at $23 billion, pretty attractive valuation, but picked Salesforce instead in the growth names because Salesforce was profitable and Wayfair has just become profitable. Not sure how the sustenance yet is of that profitability. So picked Salesforce. Now, since last 2 weeks, Salesforce is down 2% and Wayfair is up 30%. So it's a name I wish I rather included. But again, those are wishful thoughts. We have picked the 10, and that's the point of this. Never ever before have I been this public about picking some stocks and giving you update maybe monthly on how we are doing. But the point of doing this is it's fun to do and follow along. So no excuse, as little as $100, spread in these 10 companies, start a Robinhood account or whatever is the easiest for you, and follow along. If you have any questions, reach out, and hope you have a great 2021. We will continue to follow this. Happy investing. And again, this show is not run on any ads. If you find it helpful, spread the word. Just share it in your social media and tag me in your story or your post. That will mean a lot. We will get the word across to many people, as many as we can, and get them excited about investing. One thing that has come out of this pandemic is the participation of retail investors. The participation of retail investors in terms of savings, in terms of stocks, brokerage accounts, and speculative investing, but still investing, has been really encouraging. Has been really, really encouraging to see so many people getting involved in the markets, to see them understanding things, starting to get the hold of it, and starting to earn some returns and the joy and the knowledge that they gain. So I want as many of you as you can on this. If you want to follow the blog, sunnygokilani.com is the website on which there is a blog link. Sunnypoint Investing, the one you're listening to, is the podcast, and Sunnypoint 2021 ETF is the portfolio. Start away. Have a great 2021. Let me know if any questions. Share this if you love this. Happy investing. and I will follow along this pretty soon.